And it's Monday morning, 6/21/2021, first trading day of the week. And we are back live here. It's Tackle Trading's halftime report, daily show where we go through the markets one step at a time, top-down analysis style, looking at all the indexes, individual companies, items in the news, economic data, pretty much anything grabbing our attention that we think is pertinent, interesting, and relevant. Break it all down for you guys to better run your daily routine. And welcome back. Hashtag Team Tackle right in the chat as we're getting our conversation started for the week. As always, it's great to have you guys. And if you're brand new to the channel, welcome to Tackle Trading. We do this kind of content each and every day. Whenever the markets are live, we go live 12:30 p.m. Eastern. Give me a subscribe, click that bell, and come back and join us. Let's get right down to business here today. Got a good panel of coaches, full panel of coaches as well here. Got Coach Gino to talk a little bit about sectors and what's going on with the rankings over there at Tackle Trading, what he's seen in cyclicals versus defensive and all that kind of stuff. Break all those sector rankings down here in just a few minutes. Coach Matt, as always, providing lead analyst, in terms of what's going on in the market, and Coach Mark here to help us with all of it, as well as unpack the commodity markets in his Commodity Corner roundup a little bit later in the show. Pleasantries first, though. Matt, how you doing today on a Monday?
Well, you got to appreciate the market screaming back the way it is. Looking forward to breaking down the technical price action with the team here today. And Tim doing fantastic. Excited to be here.
Fantastic as always. And yeah, it is a fire back right off of that retracement that we had.
It's almost like we canceled out the 15 minutes on Friday that happened.
That one moment bringing it down. Everybody's like, all right, how do we digest it? Well, at least for one day, got a reprieve candle coming back in, in line with Friday's price action.
You always got to respect the volatility, but again, you're happy that it's firing back.
And Marky, how you doing today, sir?
I love these markets. I mean, just from a theater standpoint, my daughter bought me a new beanie for Father's Day, which makes me very happy. And I got about 400,000 Fed speeches this week. So, if you're playing a drinking game, I might not show up for work the rest of the week. If I have to drink every time they say, one of the key words that they say. But seriously, they're all out in force this week.
There are quite a few testimonies, actually. It's like the Fed lined everybody up the week after the FOMC meeting and policy statement. Now they're trying to get a message back up there. There's a bunch going on. Williams speaking today. Chair Powell's got testimony tomorrow in front of Congress. So yeah, if you're into Fed speeches, you got a bunch of them.
Well, if you're that guy, you're into Fed speeches, you're gonna have fun this week.
But it's gonna be a good week for you.
I do think the Fed speeches are important this week, and maybe even more so than typical Fed speeches, just given the fact that we're having this massive debate with the Fed right now as market participants. Are they going to focus more on the labor market and stabilization in the labor market, or are they going to combat inflation? And we're doing this song and dance with the Fed because, quite frankly, they have not been clear with exactly what they're going to do. And they're all over the board with that. And so the transparency the Fed has been given has led us market participants to play that game of what will the Fed do based on these economic reports. We're watching data the same way they are. We're trying to interpret that data in the way the Fed's interpreting the data. So once again, this great debate we're having, and it's all regarding monetary policy, the dot plot, and what's been transpiring the last few weeks. But are they going to be focusing more on labor market stabilization or inflationary concern? And in the last 12 years, in any scenario they've had this debate, they have always sided with labor market, sided with labor market. And so it's a fascinating debate, and I do think the Fed speeches will give us context to that debate, but it's not going to tell us one way or the other exactly what the Fed's going to do in 2 years from now.
Yeah.
And quite frankly, nothing will tell us what the Fed's going to do in 2 years in this debate, but we're all trying to get that interpretation down.
Mm-hmm. Well, and frankly, we don't even know what the Fed's responses to any actions they take will be right after the fact. You don't need much more recent history than 2018.
What's the most dovish path forward? That's the path.
Is that the path they'll take? Eventually, they will take. Well, they tried.
I could have said what's the easiest path forward. That's the path they typically take too, but.
You know, the market was saying they tried to put their hawkish feathers on last week, Matt. I don't know if I'm reading it that way. I think it might just be a lack of clarity.
That's the interpretation of hawkish.
Yeah,
I need more re-education in my life if that's the interpretation of
the
hawkish.
phrase I've been using is less dovish. I mean, because relative, right? But yeah, the financial media was using the word hawkish, just less dovish, right?
Well, and got to get Gino in here. Gino, how you doing today on a Monday, sir?
Good, doing really good.
Great, buddy. We're looking forward to the sector breakdown here in just a minute.
Yes.
Let's talk about this bounce in the market here, Matt. And let's start from a technical perspective. There's not a lot of key news drivers here this morning, but the technicals obviously are firing back. S&P 500 up nicely. Dow is getting a nice rally back, as some of these cyclical areas like industrials, financials, energy are having a real nice day here today. What do you see on the S&P though here first off?
Yeah, first and foremost, let's start with Friday. Friday, we were looking at a market that was testing some fairly important short-term support levels. Let's look at this on a 30-minute chart. First and foremost, you see that 4180 by 4185 double bottom on Thursday. That just got annihilated here on Friday. Once you clip support Friday, you started seeing this downward movement, and then obviously the selling just got pretty aggressive towards the late end, the last hour and a half of the trading day. And when volatility comes in the market and you start coupling that volatility with decreasing price action, because remember, increasing volatility is either up or down. You can have markets that are screaming up with increasing volatility, but typically that volatility or that increase in volatility, typically we couple that with the downside movement in price. And so with the increasing volatility we saw last Friday, but really kind of Wednesday through Friday of last week, you couple that with the violations of support both from a daily perspective, an intraday perspective, but also a daily perspective, you're always going to get into that mode of, all right, how far can this go? And so you start looking at the market of where can the bottom form here? Where can I start recapturing a little bit of confidence in the market at support levels? And that's what I loved about the stock report this previous weekend, produced by Coach Greg Holmes, Old Money Holmes over there at Tackle Trading. He talked about how different types of traders, traders like Mark, for example, who are a little bit more longer term and they want to focus on big picture and where sell-offs can really find support, and they focus and what Greg was talking about is looking at weekly charts and identifying where those very, very powerful levels of support are, like the rising 20-day moving average on a weekly chart or the rising 50 or something along those lines. And we're not in that range yet on the S&P, but I love the write-up because it kind of got you into the frame of mind what we like to look at of where these markets could stop. And then he also talked about traders, such as myself or other short-term traders like Tyler, who we'd like to, or Frank, quite frankly, where, we'd like to find the backdrop of where these things could stop on those weekly charts. But when volatility ensues, what I like to do is, yes, I like to get a foundation on that weekly chart of where these major support pivots could occur. But what I like to live on is I like to live on short-term charts, because that's where this shifting volatility, where you're going to see it the first. And so when I'm looking at this from an intraday perspective, and we'll go to Coach Frank's hourly chart here, this is the scene you're looking at on Friday. Increasing volatility to the downside, getting just absolutely butchered coming into the weekend. Once support got clipped on Friday, everybody was just like, okay, let's just get this done. Let's just get this week done. Let's live to fight another day. Let's capitulate. Over the weekend, you have a little bit of positive type news coming out regarding infrastructure and the potential of an infrastructure type bipartisan agreement. Right now, you have 11 Republicans, 10 Democratic senators proposing close to $1 trillion infrastructure plan that would it's not nowhere near the 2.3 trillion American what does Biden call that 2.3 trillion dollar
American
plan?
Jobs Plan.
American Jobs Plan.
That's right.
And so it's not into that type of ballpark, but you are talking $1 trillion over a 5-year time period versus 2.3 trillion over a 8 to 10-year time period. And so you're close there, and especially you're close on roads, bridges, transit, broadband, what most people would consider traditional infrastructure. You're pretty close on the numbers regarding that plan as well. And so you had a little bit of positive news. Whether they get Biden has not came out and supported it. We haven't seen Republican leadership come out and support it yet either, but you do have them discussing, and so you do have the beginnings of what could transpire, and so you had a little bit of positive news come out there. Obviously, the cyclical areas that got beat up quite aggressively last week, looking specifically at come back out to the daily chart, looking specifically at industrials, looking specifically at basic materials, looking specifically at finance. These areas of the market that got really beat up last week as you started seeing that quick rotation out of cyclical and coming back into growth a little bit, you saw that quick rotation. Well, those areas of the market, obviously infrastructure is going to impact those areas of the market. And so the question I have, and it's really kind of an open question, is this just an oversold bounce on a market that's just buying up at the lows with the buy the dip, or is there some real movement coming back? I don't think that's going to be answered early on this week, because technically after such a movement to the downside, these areas of the market are going to fight against some fairly decent resistance levels coming back. And so I don't think we're going to figure that out early this week, but maybe coming into later part of this week, later or early next week, maybe we get a little bit better, clearer picture on the cyclical areas of the market, and if the increasing volatility last week is a short-term bump in the road to price appreciation, or if it's something a little bit more concerning. Again, oversold natures, a lot of times they get a little bit extra upward movement in price until they find those resistance levels. So I think it's an open question right now, but you got to respect it, especially on the backs of what we're seeing from a political perspective. Can they get something to even remotely close to what we would consider a finish line regarding infrastructure? Paint me skeptical. We've seen this song and dance many times, but at least they're talking, right? At least they're talking.
Yeah, the discussion's popping back up in the news for the first time in a couple of weeks, obviously, as Biden been traveling, a bunch of other stuff been going on. But yeah, the fact that they're talking, getting some headlines out there, maybe that can become a theme as we move forward and start to paint out how that deal would look like.
And it's a maybe. And again, I'm skeptical on that. Right now, I got these areas of the market simply being oversold in the short term. And again, how many times have we seen short-term oversold positions get gobbled up pretty quickly until they come into resistance? And then that's where the game really starts here. It starts with the foundation of support, but we really don't start seeing that battle play out until these resistance levels are hit. And remember, we don't have to go back far in history to understand how this game is played. Remember what we talked about regarding, I came to discretionary, but what I wanted to look at was technology. Remember this drift down to the bottom in technology. Oversold conditions, choppy action, and we were all looking at this scenario here going like, we're very concerned about growth, we're very concerned about tech, and then 2 days later, everybody's talking about bear stop out day, right? And then 3 weeks later, we're fighting against an all-time high base potential breakout. And so right now, you're looking at industrials, and you're saying, man, oversold, is this a viable opportunity? Probably not in the short term until we start to see those resistance levels get broken, very similar to what we saw in technology. Once again, bearish action all the way down, everybody puking up growth, everybody puking up technology, everybody getting rid of it. What they could not get rid of growth faster in this environment. And yet what happened? Came into resistance, a battle ensued, support held, you finally broke out, and you had a clean trading environment. And so when you're looking at the cyclical areas of the market, maybe not so much energy. I like what we're seeing in energy. We'll get into that in sector analysis and the commodity corner later on today. But regarding the other areas of the market that were aggressively sold off, if you want to call it that, the cyclical areas of the market that did get fairly substantial downgrades to tackle, and I'm looking forward to Coach Gino's take on that when we get into sectors. But when you're looking at these areas of the market, again, it's always step one, step two, step three. Step one, you got to find support. You got to find support. Where could those support levels form? Obviously, we look at historical technical catalyst of support. A significant number like $100 absolutely could form support, but we want to see it. We don't want to believe it. We want to see it. We want to see this support level get formed. We want to see it fight up against resistance. And then we want to see that bear stop out day where it blows past resistance and there's no other reason to short anything in this area of the market. That happened in technology. That happens in reversals. What could it happen? In discretionary. That's what you're seeing here at the beginnings of in discretionary. You got to like what you're seeing a little bit in discretionary. Again, everybody's running for the hills. Bear stop out day, consolidation, clean breakout. This took a little bit of time to form. When you look at technology and the reversal that we saw in technology, this took a little bit of time to form. And so if your analysis is, looking at industrials, looking at basic materials, looking at, finance, looking at these areas of the market that got caught up and were really the storyline last week, got caught up in the volatility last week. If the analysis is, okay, where could these bottoms form? Well, they could form now, but very similar to technology, very similar to discretionary, very similar to other markets in the past that have clipped major support levels. It simply takes some time. We know what we're looking for in those areas. We're looking for industrials to find support. We're looking for basic materials to find support. We're looking for finance to find support. They're in the zone of those support levels. You look at the weekly averages. Coach Greg wrote up, and it was based on kind of what we were talking about in the scatter report meeting last week with Coach Mark. And I asked a question to the traders because we have a lot of diverse collection of traders at Tackle Trading. We got short-term traders, cash flow experts, you name it. So I wanted to get a perspective of all the different coaches. What do you look for in preparing for a potential reversal here? And Coach Mark's talking about his long-term stuff. He's talking about, well, the first thing I look for is those weekly support levels, right? That 20-period moving average. That certainly can act as a support level, and it is acting as a support level in finance.
Yeah, I mean, Matt, I don't think it's a coincidence that it came down to the penny. Looking at finance here on the 20 weekly, it was going to find the 20. It was going to find the 20. Momentum started. There wasn't a support level. Where's the next support level? And I like what you said. The game's just starting, right, in figuring out these patterns, But this is the first test of that game. Now, it can meet resistance and come back down, but this is the first step of the game. And it came down to the penny and bouncing this week.
It did, Mark. This is like the first quarter of a basketball game where the Jazz are up 26 going into the fourth quarter, and then all of a sudden the Clippers win by 10. We got to let the game play out. Okay, and yeah, I'm a little still salty from last week. I'm still salty. I'm not over it, Rudy. Rudy, you're the defensive player of the year, bro. Maybe play some defense. I'm not over it.
Hey, but breaking news, the Clippers are still scoring on Rudy.
Somehow that is true. Okay, so but this game just started. That game is over. Gino, you not yet. I'm not prepared for this yet. But the reality, once again, coming back to the analysis, those long-term analysis, they're going to be looking at these long-term weekly support levels to indicate where support could form, right? But it's the short-term trader that comes down on that weekly, on that intraday chart, that really gets the pinpoint of where these reversals could actually happen. And so you're at the beginning stages of it, but it's going to take some time. When volatility increases in the market, guys, it doesn't just stop. It doesn't just stop. It's not like all of a sudden for an hour on Friday, we lost all of our mind and today we're acting clearly. So I think we need a little bit of time in these areas of the market. We'll get into the sector rankings with Gino here in a second. But once again, I'm looking at these areas of the market. I'm seeing finance at a fairly significant weekly support level. It's going to be a very important test there. I'm looking at materials doing the exact same thing as we're seeing in finance. And obviously, we're looking at a very similar type longer term chart when you're looking at the industrial area as well. And so I just want to talk a little bit today, Tim, about what we like to look for in it for volatility to subside. Those longer term traders, they like to live on those weekly charts to really see volatility and see opportunity. Short term traders, what are we going to look at? We're going to look at things. We're going to look at 30-minute charts. We're going to look at hourly charts. And even though I don't feel gold is a buy, I do feel it does a fairly decent, it helps you understand what I'm talking a little bit from a chartist perspective. You see the increasing volatility to the downside where gold is just getting absolutely butchered. Technically, again, those longer term traders, what are they going to look at? They're going to look at this support level right here. Let me draw that much better. And again, I don't feel gold's a buy. I'm just showing you kind of what we look for. When you're looking at those longer term traders, they're looking at these key zones here. And they're saying, okay, this is a key zone with a very important 1700 backstop. That to the longer term investor, the longer term position trader, they're saying, yeah, if we can stabilize here with the short distance to the backstop at 1700, that could represent an opportunity from a longer term perspective. The short-term trader, they say that's fantastic, that hypothetically could, but I want to see it. And what I want to see is the volatility subsiding here on the intraday chart, followed by upward movements and trend analysis following that reversal. And so you are seeing that here today. But one day against this backdrop, I still need more time.
Mm-hmm. Yeah, and I think it's a wonderful breakdown as to what we're going to want to see as charts develop. Obviously, a one-day reprieve is not just clarity that the markets are going to fire right back to the upside. So I love that you went through all of those.
It's better than a one-day not.
It's true. That's a very good
It's
point.
better than a continuation of what you saw, because again, think about it like this, guys. What if you saw the continuation of the selling from Friday to today?
Different conversation today.
The entire world is having a different conversation today if finance is just destroying this pivot point right here.
Mm-hmm. Mm-hmm.
You're having a vastly different conversation. So one day reprieve, I think that's important because that's the beginning of the volatility shift. We'll see if it can continue throughout the week.
Well, and last night when I went to bed, I was looking at the market news and I thought possibly we were going to be looking at a red day here today because Asian markets were selling. In Japan, they had a pretty sharp sell-off and whatnot. Europe put in a little bit of a bottom out, and the intraday futures markets have been improving, as we came into the cash open on the S&P 500. So a lot of this on the backs of Europe kind of stabilizing, then the U.S. markets firing off here to start the week. So it's been an interesting, even just last like 12, 15 hours, as it's kind of fired up off those lows.
Well, you had some, obviously, with the China and China and Japan, they kind of, Australia, New Zealand, China, Japan, they kind of start that futures market on Sunday night. Mm-hmm. We don't typically see a lot of price action in the futures market until Europe and London start opening up later on in the night. But you did have some interesting data coming out of China that did have an impact on the stock market, but specifically on Bitcoin. And China's cracking down. And so the news came out last night that China's cracking down on Bitcoin. This is following the last couple weeks where China is also cracking down on inflationary pressures in the precious metals area of the market as well. And so that was just a little bit of let's go through it again. But given it a 12 more hours of time frame, you're really seeing this as specifically to the crypto market and not specifically to the stock market.
Mm-hmm. And while we're on the Bitcoin chart, might as well give that news, break this one down real quick. I mean, they have been cracking down like you've been talking about, Matt, and they've had some strong language around crypto markets for years and years and years. But some action here recently in the Sichuan province, they shut down 26 mining projects. They told local electrical companies that you can't provide electricity to these, sites where people do Bitcoin mining. That's the second largest province for Bitcoin mining in China, which is the largest Bitcoin miner in the world, doing about 60% of the global Bitcoin mining as of 2020. So they are cracking down. It is news, and it is
Can I ask you guys a question that Yeah, it's just more interesting to me than anything.
Hmm.
If we saw news come out in the gold mining community that all miners were shutting down, what would happen to the value of the miners?
I was thinking about this morning. They would go, the
They'd
value
go
of
through the
gold
roof.
would go through the roof,
They'd
and
go through the
miner
roof.
stocks would go up because of limiting supply, right? Yes. It's
It
curious.
just makes me curious.
It's curious. I know.
It doesn't make sense.
I had the same question this morning. I don't have a great answer for you because they are
It
obviously.
made me think about real demand out there, quite frankly.
Well, there's some speculation, and I'm not saying I have this opinion, but there's some speculation that when you shut down these huge mining projects, they hold a lot of Bitcoin and they start dumping. But that's just again speculation.
It makes me think about the demand question.
Yep, I know. I was scratching my head this morning over the same question myself. But
that province in China combined account for what, 70%?
It's huge. 60,
of crypto
70.
mining?
Yeah, I've seen both
Like,
numbers.
it's massive.
Mm-hmm.
You're shutting down most of it.
Yeah.
And so you're basically shutting down all of the supply, but yet price goes down. That's not how it works typically in commodities at all.
Mm-hmm.
Like, that's the polar opposite of the typical commodity conversation we have. Would you agree with that, Chuck?
Oh yeah, I mean, listen. It's silly. It doesn't do anything to change the picture big term at all. In fact, you could make the argument that China, which is, I mean, I don't want to go off for 20 minutes on a theoretical rant, but I mean, China getting out of Bitcoin is potentially bullish for Bitcoin. So
yeah, you would think so. Supply demand, but
supply demand plus China dirty energy gives all that pressure on dirty mining, right? There's a lot, but listen, it was in a technical short-term downtrend. It's going to be hey, we got a good battle coming up here at support. There's a lot of theater going on in various markets right now from a technical perspective, and coming down to a support zone. Can that 30,000 level that's been tested a few times in the last month hold? That is the big one for me.
I see a box.
Yeah,
the box. Can the box hold?
There's going to be hot takes on China getting out of crypto, whether or not it's good or bad. I have a hard time seeing the good of the Chinese economy getting out of crypto.
Yeah.
I'm skeptical on that.
Yeah, I don't have that hot take at all, quite frankly.
Yeah, but let's have that conversation on the podcast because I'd like to hear Mark's thoughts on that.
Yeah, sure. I know I do, and I have some good. I mean, I have some thoughts. I
think it's a debate, and I have a hard time seeing the second largest economy, the number one producer, if they got out, which I don't think they will, but if they did get out, being bullish.
As Powell would say, I've been thinking about China.
We do a lot of that lately.
So, and I'm ready to have the talk about the talk on China and Bitcoin.
All right, that sounds like a JPal podcast then.
Sounds like a podcast convo. We'll definitely have it as we record a little bit later. We always put our podcast out on Mondays out there. While we're on the chart though, Matt, it is a big support test. Anything you want to add to the technical read here?
No, the price response obviously negative. You're still within the ranges. Bitcoin had the moment where it could have broke out, had intraday support going into that breakout, did not occur, coming back down into the ranges. I don't think you're looking at anything, quite frankly, until you break out of these ranges.
Mm-hmm. I do want to get to Gino's sector.
And very quickly, if it breaks 30, Mark might get his 10.
10's in play.
Because go find a support level on that chart.
No, 10's in play if 30's broken. Obviously,
10 to 12.
20's going to have a little 10.
MicroStrategy better sell some more junk bonds to get ready to buy even more. Hey, pretty soon MicroStrategy is going to own all the Bitcoin.
Well, they own 3 billion right now.
Yeah, they own about, what is it? Not that much relative to the whole global supply, but no, they keep piling in. They keep piling in for sure. Matt, was there anything on the other indexes you wanted to take a peek at before we move into sector analysis with Gino?
No, you're seeing a very similar price response in the Dow Jones, firing off support here at 33,000. Obviously, from a trend perspective, though, again, you like the price response here today. 33,000 on the Dow coincides with an old resistance, new support level as well. Looking at the Russell 2000, you got 2,200 here on the Russell 2000. That, to me, again, Russell got caught up in all the volatility last week. But if you want to talk about a market that could recover and look really, from a technical perspective, look a heck of a lot better than the rest of the markets outside the Nasdaq, I'll get into that here in a second. It's the Russell 2000 because, yes, you violated a lot of moving averages here, but technically speaking, that would be a higher level of support versus the backdrop of horizontal support at 2120. And so I do think the Russell 2000 could look better technically, meaning a little bit more consistent, quicker than what we're seeing in the Dow, quicker than what we're seeing in the S&P. And again, we've been looking at that Russell 2000 starting to show a little bit of strength, and I still got it showing a little bit of strength here. And then when you're looking at the Nasdaq specifically, the Nasdaq, you got to be very impressed, holding up against the volatility last week that we saw in some of the defensive areas, that we saw in the cyclical areas of the market, holding that high base type formation where you're consolidating above your moving averages. Holding, it's volatile, no doubt, but you still got to be impressed that it has not violated any support level. And when you're looking at, and Gino will get into some of the rankings here in just one moment, but when you're looking at some of our reports over the weekend, the stock and options report specifically, let me just take a quick peek. You had tech in there, you had comm in there, but you also were looking at a scenario where Apple showing some love, Microsoft showing some love, Amazon showing some love. And these stocks, when they want to move, I don't care what happens in the rest of the market, these type of stocks, Apple, Microsoft, Amazon, Google, those big stocks. Remember the FANG, right? Kramer's FANG.
Mhm.
Remember that? Those stocks drove this market for 5 consecutive years. 5 consecutive years. It was the only thing any trader talked about. Everything else was, oh my goodness, these are an index in and of themselves. Can they start moving? I'm really liking the price response on Apple. I'm liking the defensive nature of Apple over the course of the last week. When the market is showing weakness, Apple showed some strength. I think that's a positive development for Apple moving forward. Amazon's had those moments where it's like, man, you got to get ready. Here you got to get ready. I think you're looking at that same thing here on Amazon. You got to get ready. This is a long-term neutral type trend, but you're seeing increase in support on those weekly. You got a clean trigger above that 3,500. Can Amazon break out and run, carry that consumer-dependent XLY contract? Can it break that out as well? So there are concerning things in the market, no doubt about that, and we can focus on those concerning things. But I'm seeing some positive in this marketplace starting to set up, and I loved that scouting report meeting on Friday.
Mhm.
Again, the volatility. Sometimes volatility, it's scary. It's not sometimes. Increasing volatility is always a little nerve-wracking, but
It should always be respected.
Yeah, 100%. But when it subsides, it's like that tide coming out. You find some gems. I think we found some gems in those reports over the weekend.
Yeah,
Yeah.
no, I like increased volatility should always be respected. It's one of the things that I've seen like in message boards and new traders when, the market's down one day and they're like, oh, buy the dip, like a 1 day or 2 days, always buy the dip in that mentality. Increased volatility should be respected. Because, if you respect it every time, you're going to be very happy in 20 years. If you ignore it, every once in a while, it's going to get you good. So just respect increased volatility. That's all.
Mhm.
You don't have to run. You don't have to be scared. Just respect it.
Yeah, definitely worth respecting. By the way, while we're on Amazon, I do want to mention they are starting their 2-day Prime event here today. Consumers Paradise, reportedly, I guess, they did 10 billion in sales last year. Matt, a lot of different companies are following in line. Do they do the same kind of thing? Walmart has big sales on their website right now. Kohl's and Target doing the same kind of thing.
Yeah, we started this a few years ago. We're trying to create 2 Christmases, one in June and one in December. We'll see if they're successful at it.
We'll see
But
if they can pull it off.
last I checked, I thought it was Amazon Prime Day every day.
It feels like that lately. And I actually kind of wonder if they're going to be able to pull it off this year. A lot of their suppliers have been having supply, side constraints and all that kind of stuff. Stimulus checks went out in March, not in June. It'll be interesting to see what the numbers come in. But I love the potential on Amazon's long-term breakout if and when it does happen.
Oh,
I think
especially if you
everybody's
get
got to
a
be all over that.
snapback. If you get a snapback, because you're a little overextended on this potential breakout,
Mm-hmm.
get a little bull retracement, get a little high base action, let that 9 catch up.
Mm-hmm.
Let that 9 catch up, and then break that.
Well, imagine if we
asking.
actually did have the stock split they were rumoring at earlier
They
this
need
year.
They need it.
It's time, Amazon. Well, actually, the time was like 5 years ago. It's well past time, Amazon.
Yeah.
I agree. All right, let's get Coach Gino in here next. And Gino, every weekend you do the newsletter over at Tackle Trading. You break all the sectors down, look at the analysis from a rankings perspective that the coaches kind of put all together, and you give some analysis for our pro members out there in terms of what's happening in the market. We bring you in here on a Monday to break those sectors down as well. Can you run us through the defensive or the aggressive areas, wherever you'd like to start, and kind of give us a bird's eye view of what you're seeing from a sector perspective?
Yeah. So, owning the newsletter, we do a top-down approach to the markets, and we did go through quadruple witching Friday, which causes a little bit of volatility. That's the quadruple witching, which was last Friday. We're halfway through the year, guys. It's June, right? So that is when the stock index futures, stock index options, stock options, and single stock futures all expire simultaneously in the market, which is a big shift in money. Then we had the FOMC meeting, right? All this usually causes volatility, just like you talked about in June, on the last half of June. So this is the start of volatility season of June. With that said, Tim, historically, utilities and healthcare are usually the best, which are safety sectors, because of volatility spooks people, they go to safety. Worst historically is financials and industrials. So with that said, we saw that last week. We saw our biggest downgrades in financials. Now, if you're looking at the gridiron, we're on the 20-yard line. We made a pretty big adjustment to financials. We pulled it all the way back to the 40. And like Matt said, yes, it pulled back on the daily, but you got to really look at the weekly charts on a lot of these sectors, because on the weekly charts, you're setting them nicely. I mean, look at financials on a weekly here. And then, as I mentioned on the newsletter, this is one day here. I was expecting a bounce back this week, a recovery bounce, if you want to call it, because the catalyst last week, I think, that caused the most volatility was the FOMC meeting, the outlook on interest rates, and that made the US dollar really jump. That was the only upgrade we did on our gridiron, was the dollar. We actually went from a negative stance to slightly bullish. And it's most like neutral bullish. How's it on the dollar? It's very overextended. And like I said on the newsletter, it doesn't do that more than a couple of days, then it pulls back. And that's what we're seeing today. So the dollar had a negative effect on financials, had a negative effect on materials, which was our second biggest downgrade, materials, and industrials. And a little bit on energy, So when you look at those cyclical sectors, that's where we had the biggest downgrades. And we talked about that last Monday. We were talking about the different, groups of sectors. We have growth, cyclical, and safety. You can break them down into more than that, but that's just how we're going to keep it simple. Now, as far as safety sectors, we have healthcare, staples, utilities, and real estate. Really, the biggest downgrades in safety we had last week were utilities and staples. Now, these aren't real big sectors as far as market cap, staples and utilities, but utilities, we've got that down as neutral. That's our weakest sector so far. Now, again, let me remind you, like I said earlier, these are usually your winners, healthcare and utilities for June. Not seeing that this year, not seeing that so far, but the month's not over. So that's interesting that the safety plays were actually downgraded with the kick in volatility. So that was real interesting. You see the volatility didn't spook people to safety. It actually made people take money out of the high flying cyclical, which has done really good for a while. So right now I'm seeing a little weakness in financials as far as setups and stocks. But now the winners, we didn't upgrade them, of course, like Matt said, was technology, discretionary. They held their ground, and they are the biggest market cap in the market. In fact, just so you know, Apple, Microsoft, Amazon, Facebook, and then you got Alphabet, which is two symbols, Goog and Google, we call it, right? That's 20% of the market, those 5 companies right there. That's 20%. Those guys are all holding up really good. So it really is its own little sector if you put those 5 stocks together. You want to call them the 4 horsemen, the 5 horsemen, whatever you have it. And that's technology and communication. So when you see all these arrows on our gridiron, all these downgrades, you go, wow, don't you think the market would be downgraded more? No, because you got technology and discretionary, which are a much bigger percentage of the market, and the healthcare hung in there too. And we have them classified as a safety play, but the healthcare did hang in there. It did hold its ground. We see a lot of strength coming back into technology, which held the market up. So all in all, Tim, with the dollar retracement, yes, you're going to see a bounce in those cyclical stocks. We got it this morning, right out of the gate. And in the newsletter, I said, I'm going to give it till Wednesday to see how far this bounce is. Because as you know, this bounce, heck, it could end today, right? It could turn around today. We need to see 1, 2, 3 days and see how far financials recover, how far materials recover, and if the dollar continues to pull back.
Mm-hmm.
And that one will see, is this a recovery bounce or is this a trend back in place? But also the technology and discretionary just shook it off. Mm-hmm. So sector-wise, you got to pick wisely. You got to be, okay, you got to watch your sectors wisely. But financials was very, very volatile.
Maddie, anything you want to add to what Gino's having to say here?
Yeah, in a couple points. He was talking about kind of what's happening with cyclical into growth into the defensive areas of the market. And if last week we're looking at a marketplace in the S&P and the Dow Jones and the Russell 2000 and the Nasdaq, where you basically see money coming out of all marketplaces and flowing into a defensive capacity, right? We know that drill. We know what happens here. When the market gets spooked, it initially sells growth and cyclical and it gets into safety. Initially, it will just go cash though, and then it will reallocate. And so when you have this flight out of equity markets, the flight is typically everything. We're selling everything, and then we reallocate back into a more defensive capacity, typically staples, healthcare, utilities, real estate, gold, these types of financial instruments that are traditionally seen by market participants as safety, defensive. Remember, money doesn't typically come out of the market, it just rotates in the marketplace. And so if last week we saw a scenario where everything was coming out, yeah, you would be concerned about the market's viability at that point. You would still want to see it play out over time, but you would be concerned. That's not what I saw last week, though. I saw it, and what you're seeing here today, I think, does lead into the conclusion that this is sector rotation happening. And remember, everything in 2021 is simply faster than what we have seen in traditional marketplaces. And so we like to price in things fairly aggressively as market participants these days. And so when you're looking at a scenario where money came out of cyclical, which has been extremely strong for the last 8 months, yeah, you're going to see downgrades in materials, industrials, energy, finance. You're going to see those. But again, what did you see? You didn't see growth get beat up. You saw comms get just slightly downgraded by 5 points because of and not volatility, just simply trying to find support here in comms. But what you saw, and I think it was very telling, is the two sectors that really are pertaining to growth, and that would be the technology sector and the discretionary sector. When you're looking at those two sectors, not only did those two sectors not get beat up last week, but let me come to technology. Technology had one day last week where it was concerning, and it got gobbled up the next day. It never violated even a minor support level. Yeah, intraday analysis was violated, but that's going to happen in every volatile condition. A daily support level was not violated last week on technology. It held its ground in the face of that volatility, and I do think you have to see that as positive for technology and growth moving into the immediate short term. Same thing can be said about discretionary. Obviously not as strong as technology. Technology's up around, the 180 level on this, that would be on this chart, fighting against an all-time breakout. But I do think you got to be a little bit impressed with discretionary on the backs of the Amazon strength over the course of the last couple weeks. Held its ground, never violated a support level, stayed in that cup and handle formation where you're still looking at a potential breakout of 174 before you see some fairly decent price appreciation here. And so based on what I saw last week, I do got to look at this at this point as traditional sector rotation, money coming out of cyclical into more growth areas of the market than something that is more concerning with a broad-based sell-off where you really need to see everything subside from a volatility perspective. That's not my take here. I think I got this as rotation from cyclical, where we have some concern, and obviously has had a lot of price appreciation since the election, back into growth. I got the same rotation happening here.
It's an interesting thing we got to keep watching, obviously, to see if this thing can confirm, because a true rotation back into those growth areas, if we can get a breakout on tech, break back up in discretionary, that's a new character for the market, Matt, that we haven't had for a little bit. So
yeah, and I'm not calling the end of cyclical by no means. That's not. Remember the anatomy of a bull market. Things take a break, guys. Mm-hmm. That's what Coach Tyler always says. They take a break. And you know what? When you're looking at those cyclical areas of the market, I'm with Gino. You're oversold on the short term. You're coming into some major weekly support levels. I think the clearest path forward this week is for these areas to get gobbled up in the short term. But the problem that's going to arise is you're going to find some very, very strong resistance levels as it comes back up into price. And so as materials, for example, starts to fight back up into resistance, you got a tremendous amount of resistance between 84 and 86, a tremendous amount of resistance, both horizontal and vertical. So you're going to have some important fights there that certainly could see double bottoms, double tops, and eventually a right shoulder breakout. And you don't have to go far to understand how long right shoulder breakouts can occur. Look at Snapchat here. Could have occurred here. 4 months later, Snapchat's still talking about a right shoulder breakout. And so when you're coming to the sector, once again, materials, you could see a right shoulder type breakout, but that's going to take some time. Mm-hmm. And so for me, I'm looking at this first and foremost. Step one, you got to find support this week. Step two, let's see that let's see that fight at resistance, and then stabilize that resistance before we see some degree of breakout. We're very early in that analysis. What we're not early in is we're not early in the potential high-based breakout that we're seeing in technology. We're not early there. We're not early in the potential right shoulder breakout of 174 in discretionary. We're not early there when you're looking at some of the other sectors like healthcare. You're looking at a potential, neutral type formation with a breakout there. We're not early there. We're not late there either. Or early. You're looking at an area of the market where you still have significant great trades going on. And I just come back when we see these rotations. Yes, it takes all of us a little bit of time to catch up to rotation, but we're in the beginning stages of it, in my opinion. And we still need to see further evidence of this to see true rotation, because true rotation doesn't take days and really doesn't take weeks, guys. It takes months. And the same thing with the cyclical argument of true rotation back in November. That took, 6-7 months to transpire? And so I just think if we give the market, especially those cyclical areas of the market, a little bit of time to breathe, Let's see where that pain really is. While that happens, we got clean charts in some of the growth areas of the market.
Yeah, it's going to be exciting to watch and see if those things can develop. And obviously, patience around any chart development is very, very good advice, especially on those deeper retracements that are just now trying to fight for support very early in that analysis. Appreciate both of you breaking all that down.
And last thought, this
Mhm.
is still a stock picker's market, in
Absolutely.
my opinion. That has not changed, and that has not changed in the last 8 months. This is still a stock picker's market, but you want to identify the areas where the majority of the money is flowing to make your stock picking simply a little easier.
Mhm. Yeah, good
Yep.
bit of advice there. All right, last thing we're going to be moving to. We got a couple of stock items we'll get to a little bit later in the show, but we do need to talk about the commodities market in this week's commodity corner. Coach Mark's going to break down gold, crude oil, anything that he is catching his attention that's interesting to him. Marky, where you want to start with commodities next, my friend?
Oh my goodness, there really is so much to talk about after last week's volatility. Let's start with oh goodness, where do you want to start? Because let's start with gold. Let's
Gold's
start
fine.
with gold.
Either one. Yep.
All right. So I mean, and several times in this show, you have heard Gino or Tim or Matt make some reference to, listen, oversold conditions can create bounces. That is a very normal, par for the course, especially it seems over the last 15 months. It's always been true. But you get short-term oversold conditions, it can create bounces. And the problem with bounces is they're almost expected, like Gino mentioned on the dollar, it's almost expected that it's going to happen. And when you get a severe decline over a few day period, the bounce can be very dramatic. You might be seeing that in some areas of the market today, in lots of areas of the market. And it's just very normal par for the course. And like Matt just said, everything's faster these days. So 5 years ago, 7 years ago, some of these bounces, they would be there, but they wouldn't be as dramatic as the ones that you experience over the last 15 months. It just is a faster market. And I think those fast market conditions might be here to stay for the rest of our lives. But that is a conversation for another day. But what we do know from technical perspective is that you get short-term oversold conditions, and on the way down in those short-term oversold conditions, aside from when that fear subsides, when that panic subsides, you don't have any resistance levels on the intraday chart of note on the way back up. And so as it starts its ascension, and you saw this really dramatically on the S&P 500 over the last 48 hours of trading, on its ascension, it's a ways to go before you find real resistance. And so what that can do from a short-term trading perspective is it can create a lot of havoc, right? Day traders usually do very, very well in these environments. But for long-term position traders like myself, it's a wait and see game. Now, the one thing I always do, because for me, price stability, because I'm a cash flow trader, and particularly because of the style of trading I do, stability is the most important thing. Whenever you have breaks of support on the intraday chart, on the daily chart, which you did last week, I mean, we had a nice little short term at the top, it broke support, and on that support break, I get defensive. I take existing covered calls I have, I roll them down, I might roll them down and out. I take defensive measures. Now, very rarely am I exiting positions, because most of the time I am position trading / investing, not short-term trading. And I think that's very applicable with gold. But I still respect the technical break of support. You got to respect volatility, and you got to triply respect support breaks. Now, so when we get in this like little technical situation we're in gold, it's not the first time you're going to see this, and it's not it is not the last time you're going to see this. You are going to be faced with this technical situation on individual stocks, on the markets, on a commodity all the time. I look for, after I've done my trade adjustments on the break of support, I'm like, all right, where's the next support level that can form? Where's the next line in the sand? Like on the Dow Jones, you came down to the 20 weekly. That's a potential line in the sand. When I look at gold, I'm like, all right, where's the next real big line in the sand, one that I can trust, one that I might be looking to purchase if I get a reversal signal. Now, those reversal signals can take a long time to develop. But with gold, we have a very clear horizontal support level that was formed way back last year. Heck, no, when was that? Like, it's June, was that 16, 17 months ago? Came down, tested it a couple times a few months ago. We talked about that reversal off that support level, and so when I look at that support level, I'm like, all right, that's a clear, obvious. I don't have a lot of moving averages to work with on longer time frames because of the nature of the pattern. We've been trending sideways / slight downward over the last year on gold. So that negates moving averages as support in that kind of long sideways-ish trend. So that gives me those momentum indicators. It takes them off the table. And so I'm dealing with good old-fashioned horizontal support. And then I look at, all right, so if we get a rally, if I get a rally at some point, where's the resistance levels? And where's intraday support, which can take some time to form? And so when I look at a chart like gold, what I'm really doing is I'm mapping out the next 6 weeks of trade management decisions. New entries, when you get in this technical situation, very problematic, for a conservative trader like me. It's going to take some time, i.e. look at Bitcoin, right? You came down, it's going to take a while for that formation to form, and you are glad when you're a patient conservative trader that you're not pulling the trigger on the dip, because we might still break that support level, right? We haven't got a really good signal on Bitcoin to go bullish in a long time. And so it can take some time to form out. And so when I get in this situation with gold, I'm like, all right, this can play out a lot of ways in the short term, but what am I looking for long term? Now, I have existing positions. I've managed them by aggressively managing my covered calls, going cash flow. So I've taken care of business last week on the support break. But now it's time for new business. And that new business oftentimes is mapping out how it can go from here over the coming weeks. So you line it up so you're not doing impulsive decisions. And for me, there are 2 things I'm looking for in gold. One, if you come down and test that support level again and get another formation similar to you that you did a couple months ago, right? That was a nice trading situation, both from a short-term trading perspective, from a position trading, from a cash flow perspective. It was a nice situation. So that's in play. The other thing in play is if somewhere along the lines we get a smooth out support level before that helps. And Matt will break that down in the coming weeks if it comes through the use of intraday charts, multiple time frame analysis. And if that type of formation forms above the support level, which is entirely possible, still going to take some time for that to form, to smooth out the volatility, it can give you another entry signal. So that is when I get a situation like I did in gold last week. That's how I look at it. Manage on the support break existing positions from a cash flow perspective. And then when you're looking at new potential entries, those different technical tests of support or a new support level that forms above it with intraday and multiple time frame confirmation that you got something upward momentum building. And that's really good when those things develop on intraday charts. So,
okay. Matt, anything you want to add to this gold analysis? Obviously, Mark wants to be patient as this pattern develops. And like you've been talking about, it could eventually look like an inverted head and shoulders, but it's going to take some time, obviously, after a deep correction to find support, establish support, and all those kind of things. Anything you want to add to this one?
Well, as Mark was talking, the whole time I'm thinking, patience. And the whole time I'm thinking, I just want to be Babe Ruth and point to the fence and say this is an amazing support level on gold and a complete overreaction to the price last week. But I do agree that, again, when you see increasing volatility, couple that with increasing participation, i.e. volume, you got to be a little concerned. There's no doubt. And one of the reasons why I was so consistent on our bullish projections on gold in this part of the analysis, as Mark was talking about, was not just because of me, but because of the consistency of price. The reason I was consistent was the price was consistent in its analysis. And so when you're looking at this, and I do think this is an overshot on gold, and I do like the position gold is in, and I do really love the zone it is in. If you were to eliminate all these moving averages, all my lines, what you're really doing is testing the breakout channel against the weekly reversal is what you're doing. And so when you're looking at this key test of support here, yeah, we're oversold, expect a bounce as you come into that reversal here. But as we test that reversal, you're probably going to see a little bit of this W response. And so let me put it like this. Where my head is at, Tim, is in this V-shaped recovery. That's where my head is at. Quite frankly, I think it was an overreaction based on the coupling of a misread of the Fed last week and the Chinese news with the crackdown on precious metals. That had a very big impact on all metals, gold obviously with that. But where my head is at is V-shaped recovery because of the overreaction to what I felt was not a good read by the market, quite frankly. But where the consistency happens is in this analysis here. Again, where Matt's head is at is V-shaped, but what did V-shape happen eventually? It got blasted. More traditional W formation, breakout against the backdrop of the support level, very consistent, very great trend moving forward. And so I do think gold's in that scenario where you love the zone. I do think it was an overreaction, right? And let's try not to combine Bitcoin volatility and gold volatility. Bitcoin volatility is 15% down in a day. Gold volatility is 15% down over 6 months. They're different. But when we're looking at it from a support perspective, it doesn't matter the financial instrument you're looking. You got to see it tested, and then you got to see it confirmed. And that tested could be a double bottom to show you the strength of that support level, or it could be in that V shape where you see an increasing support level over time. Either equation, whether or not you think this is a overreaction to a misread by the market, or whether you're thinking about just the concerning volatility in general, you want to see price stabilization here. I like the zone gold is in, quite frankly. I like it a heck of a lot more than in the face of this volatility here. And it's because of the strength of that reversal and the strength of the backdrop on the weekly chart when you're looking at that as a support level at 1750 by 1760 and the backdrop of the W formation at 1680 to 1700. The market is looking at this as an increasing support level at this point. You give it a week to stabilize, you might be seeing some W type opportunity here in the gold market. I am in the camp that it's an overreaction by the market. I am in that camp. And so I am looking at gold right now as potential reversal, but I do love the support level it's in. I want to see it form first. Yes, much like I said on the market, gold's going to fight against resistance levels as well. That's why I want to see the double bottom, not the single bottom. That's a V-shape analysis. I want to see it come into 1800, come back down into 1760. I want to see the stabilization. I want to get in the box right here, Tim. I want to get in the box. And I want gold to stay in the box for just this week. Let's see the stabilization play out. That's all I'm saying. But I do like the zone gold is in, quite frankly.
Yeah,
Yes.
and I think a lot what you do with gold is depending on if you have exposure or not, right? Like, I mean, there are so many different scenarios individuals could find themselves. Like if I had zero gold exposure right now, I probably would be looking at aggressive naked puts even last week, on gold, which is what I normally do. Having gold exposure, and a good chunk of it, it's about management right now. It's about management right now. So I would love that scenario to play out. I would love any of the bullish scenario to play out, from that perspective. But and if it V shapes, once again, if it V shapes, I get called out. I look for new opportunity.
Love the analysis from
I don't
both.
think a lot of investors get out of gold positions, quite frankly.
Long term.
Okay, and so Mark, your point of management is important, but that management in how I approach the gold management is very similar to what I was saying technically, because if you violate that weekly support level, guess what gold traders are doing? They're writing more covered calls, is what they're doing. If it holds, they're looking to add to position. And so you are right. It is a matter of management at this point. And no, I don't think new traders in gold are going to be looking at this and be like, oh yeah, let's start new trading in gold. I just don't think we gold owners get rid of gold.
I'm not done. I'll tell you that. I don't even know what
you're writing covered calls in that environment. You're writing covered calls simply to offset loss.
Correct. Yeah, you roll down your calls, you pick up a little cash flow, you let it consolidate. And I would love to see it in that box for a week, not just a week, maybe even 2 weeks. I have no problem if it backfills for a little while and creates some stability. It wouldn't bother me at all.
Gold's charts are always better when you get double bottom analysis versus increasing support V-shape analysis.
Yeah. And Terrence, I'm with you. Terrence says he loves the box. I always love a good box.
I love this box too, Terrence. I started drawing the boxes just to represent to the community kind of the ranges of certain things. I'm to the point where I can't live without my boxes. Like visually, I can't approach analysis as much unless I have my boxes.
I agree, brother. I agree. I love them too. I love them when they're right there on your charts for me to see clarity from them. All right. Last one here, crude oil, Mark. Just any quick analysis on that. I know the trend has been really,
and this is a phrase I've used with crude oil several times over the last month, that the price action was telling. When you broke short-term support and came back up about a month ago, I used that, I think it was 3 Fridays ago. I said that I thought that candle was very telling. I thought the price action, this is what I said on the commodities report this weekend, I thought the price action last week was telling. Once again, you get this move away from copper and cyclicals and this whole excuse, right? Rotation. Let's move into new areas. Let's get out of the areas that have performed the benefit in that cyclical type nature. Crude oil had another excuse to sell off. Didn't want to. And I thought the price action last week was very, very, very telling. Once again, another excuse for crude to sell off. Didn't want to take the bait. You would have thought Friday, it was just the market and areas of the market that have been tied to this whole trade the last 7 months, getting beat up really bad. Crude oil wasn't. I thought that was telling. And I think you're seeing the response today from that resilience that crude oil has. You got 75, 76 is a known resistance zone up ahead. Wouldn't be surprised if we stall there a little bit. But crude oil is very, very, very strong right now.
Well, and even the defense it played on Thursday when the rest of the commodity market was getting smacked around, obviously was very impressive. Held that 9, rode the lightning. Now it's breaking into a new high here, Matt. Beautiful looking chart. Yeah.
I watched Tenet over the weekend. Have you guys seen Tenet?
I have not. I don't think so.
It's one of those movies that gets you to think. Yeah. It's 3 days later, and I'm still like, are we sure? like one of those moments. And if you haven't seen it, watch it. It's great. It makes you think. So I'm not going to give any away storylines, but there's competing timelines in the movie, right? And right now, I'm looking at an environment in crude where Iran is going to start selling oil to the world again. Correct, Chucky?
Yeah, that's
fairly soon. And they're expected to increase supply by about 2.3 to 3 million barrels, which would impact the global supply by about 3%, correct? Okay. In that world, what typically transpires when you increase supply and a major supplier like Iran comes back on the grid, what typically do you see?
Price usually goes down.
Price goes down. Increasing supply, price goes down. What happens to crude today? It's up 2.5% and breaking out of short-term support. Short-term resistance. Bitcoin, on the other hand, Bitcoin has 75% of its supply chain shut down and is down 10%. Somebody square those two, because I don't know which side of the universe we're playing on right now.
Listen,
listen,
short-term price action is what it is.
That's not the take here. Short-term price action, you are seeing increasing supply on both, or one, decreasing, shut down supply on one, increasing supply on the other, and they're both having a topsy-turvy opposite response, and brings me back to Tenet. I can't make sense of those competing worlds, and I can't make sense of these competing worlds either.
No. Well, I mean, I have my theoretical takes on both. I'll go deeper in the podcast on them.
All I'm taking it as of right now is crude is extremely strong and Bitcoin's a nightmare.
Yep.
That's my takeaway.
That's fine take.
And I really do think sell off in energy stocks. I love energy stocks. I make no bones. I continue to love them. I think there's real value there. And I think that they're getting caught up in this trade in the stocks. At some point, the price of crude oil is just going to separate them from that trade.
Sure.
Well, it already is. Look at the strength last week in energy. Yeah, you had the one day, but it found support and got gobbled up pretty quickly. Those still stay intact. When you look at the other cyclical areas of the market, industrials blew past its 50, finance blew past its 50, basic materials blew past its 50, coming back to energy, didn't even test it. So I always think that is separating itself, and that price appreciation over time on crude has certainly aided the energy play, especially in this time frame. I certainly would agree with that.
Yeah, I think there are gobbles of opportunity in the energy space.
Mm-hmm.
Doesn't change the fact that I can't make sense and square the analysis on crude and Bitcoin.
Not today, but now I got to watch the Christopher Nolan movie. It's got my interest.
That was my way of getting Tim to watch it so we could discuss it.
We could chat, yeah.
That's all. Coach Tyler, I'm ready.
There you go. Wait for me.
I have my theories. I think I'm zoned into what's happening here. More so in a Christopher Nolan movie that makes no sense versus crude and Bitcoin today on a supply and demand perspective.
Versus the Chinese, restricting their supply. Yeah, I got you.
It's funny when you actually think about it.
All right. Not a lot of corporate items, so we're just going to go right into final thoughts here. And let's go back on the broad markets as we do that. Obviously, whenever we start the week, we're going to look at the big picture, look at the news. A couple of companies that will be having earnings this week, including Nike, which had a very nice volatility build. Those of you who listened to the podcast, we had an episode on that about 6 weeks ago when it was down at the lows of volatility, and it picked up here recently heading into earnings as it broke down as well. But here's the thing, as I'm looking at the market, thinking about final thoughts as to what's been going on out there across the marketplaces. Maddie, earnings season not till July. We're at the end of June. It's a light news cycle. We're kind of watching, the cyclical areas take it on the chin last week, trying to get a one-day reprieve. So we've got just patience in front of us. What are your final thoughts on these broad markets?
The Nasdaq's looking to break out of an all-time high, and the S&P's a stone throw away from an all-time high. Let's all have perspective when a couple of days the market goes down.
Yeah.
That's number one. Number two, I have three thoughts, Tim. Number two, and I mentioned this earlier today regarding the Fed debate. We're gonna get a lot of context around the Fed debate, and the Fed debate is happening because the Fed is not transparent. Fed, that's on you. J. Powell, that's on you. We don't need to hash that out today. But we're having a debate on the Fed and what they're going to do with monetary policy because of the lack of transparency and the lack of leadership at the central bank level. And this debate is pertaining to the labor market versus inflation, what is most important in the dual competing mandate that the central bank has had since 1913. Inflation is a mandate, labor market stability is a mandate. The labor market right now is in a very concerning. Number one, we're going through a historical evolution of the labor market that has went from needing people to automation. That's number one. That impact will be felt through the pandemic and the recovery of the pandemic as certain jobs never come back to the marketplace. Number two, we're looking at a labor market right now that is uncertain at best. Improving, yes, but uncertain at best. given the fact that before the pandemic, we were looking at 3.5% unemployment. Everybody had a job that wanted a job, and we had 6 million jobs open for the people that wanted to go back to work in the first place. We had a very strong job market, very, very strong job market. Today, we're nowhere near that. Yes, we've recovered well, but we're nowhere near that. We've seen price appreciation. We've seen earnings go up, not corporations, but individuals. We've seen all of that. We've seen the labor market respond, but we're still nowhere close to the strength of the labor market before the pandemic to post-pandemic. And so the Fed has a lot of work and a long haul to go regarding getting that labor market to where we would consider it stable. And traditionally, stability in the labor market is 3.5% to 4% unemployment. People that want a job, have a job, that's stability, right? And over the last 10 years, when we saw labor market numbers at 9% in 2009 and 2010, at the very early stages of the recovery, we saw the Fed put the labor market in front of every other analysis. It did not matter what inflation was doing. It did not matter what the government was doing. As long as those labor market numbers stayed where they were, the Fed did nothing. The Fed did nothing. And even when it got to, we're targeting 6% unemployment, we're targeting 5%, we're targeting 4%, every single time we hit those metrics from an unemployment and a labor market perspective, the Fed shifted the goalpost on inflation to continually support the labor market. The Fed in the last 12 years has supported the labor market at more in the last 12 years than at any point in its history, especially in comparison to that competing mandate versus inflation. And so many people today in the argument of the Fed, are they going to focus on labor market numbers or controlling inflation? They side with we have to cure the labor market equation first before we tackle the inflationary problem. But unlike 2010, 11, 12, 13, and 14, the Fed has never been faced, at least this edition of the Fed, has never been faced with the challenge that they have regarding inflation. At no point in that 12 years, at no point in that mandate were they ever faced with the challenge of inflation that they are faced with today, when you're seeing dramatic increases in projections on inflation at not only the central bank, but at the World Bank, at the IMF, at every central bank from around the world, at every government from around the world, concerning inflationary data. Just last week, we saw the Fed's projection of CPI go from 2% north of 3%. Guys, 2 years ago, that would have been the scariest thing this market could have heard, because for 10 straight years, the only thing we heard was, well, until we get 2% inflation, we're going to continue to support the labor market. Well, we've achieved 2% inflation. We're going to achieve 3% inflation, and most likely we're going to achieve far north of 3% inflation over the next couple of years. And so the Fed has this competing mandate right now, and they're stuck between a rock and a hard place. And that's why it's so difficult to assess the Fed, because you could logically look at this situation and say the Fed has to support the labor market. And you can logically look at this situation and say, but if they do, what do they run the risk of? What is the ultimate risk in all of this? Yeah, more people have jobs, but at what cost? And that is the debate. That is what we're talking about in terms of this competing mandate. And so it's going to be fascinating to watch the Fed over the next year to two try to navigate the mid of this internal debate. And it is an internal debate, as you're seeing more Fed members come out and say, we need to increase interest rates sooner. You're seeing other Fed members like Karkashi today come out and say, we need to get rid of the dot plot. We need to have zero interest rate increases. And I believe Karkashi would say we need to have zero interest rate increases for the rest of his life. And unlike Janet Yellen, he's actually young. And so you're having this competing debate, but it's not just us, the market participants. It's at the central bank right now. And that is going to be absolutely fascinating over the next year to 2 years, watch Jay Powell try to be Luke Skywalker and thread that needle into the Death Star. Can he do it? I don't think so. I don't think so. I think we got some concerning inflationary data coming down the pike. But remember, the one thing as a trader, the one thing as an investor, regardless of what the central bank does, regardless of what Wall Street does, regardless of what anybody out there says or does, we can always take advantage of from price action. And whether we're right or wrong in that moment, we're always going to be with you guys to break down this data the best way we can. And we hope it helps you navigate the market. And I just want to end my thoughts by saying this. I am extremely thankful to every one of you coaches because you have helped me out so much, because the combination of the way you guys see things certainly helps my analysis as well. And so it's a little bit of a historical moment for the Fed. And I love living through history, and I can't wait and I'm excited to kind of go through this with you guys over the next year. Not so excited for the inflation concern, but I'm excited to go through it on a daily basis.
Well, and those inflation prints, obviously, we're going to get a PCE report on Friday that's going to show an extreme number, but over the next 2 years, where those numbers head is anybody's guess. I know
I
that
personally think,
projected higher.
and in this debate, my personal hope is they would fight inflation more. That's my personal hope. What I believe they're going to do based on their history is they will side with the labor market. They will not act until the labor market has stabilized historically.
Yeah. Marky, programming notes from Tackle Trading. I believe we got an onboarding webinar tonight for new pro members, correct?
Yes, we do. Every Monday night, Coach Frank, two-time back-to-back winner of Trade Master. Frank's amazing. Not only is he a great trader and a great technician, he is a very thoughtful individual, and every Monday, methodically and helpful with the good spirits he always does, helps walk members through the trading labs. Not the trading labs, the tackle trading, where he just breaks down and all of the different features, because we got a lot that goes on at tackle trading, and Frank just does just an amazing job. He is such a delightful, calm individual, and he'll walk that through 7 p.m. Eastern tonight. And I can't get out of my head that Karkashi is the next Fed president. I can't get out of it. Ever since you said you're like, he's
that's
young.
Fine.
I'm like,
that's fine. But I'm watching the Manchurian Candidate tonight to verify that. That's all I'm saying. I'm leaving it at that.
Fed president.
Again, Manchurian Candidate. That's it. I'll leave it at that.
And that will be a delightful 10-year stretch on the halftime report.
I know,
where
my
I can
brother.
make 10,000 Kashi jokes rile up Matt.
That's exactly why you brought that up. You're just trying to stir up a hornet's nest over there. Not going to happen today. Karkashi.
In other news, KB Holmes reports earnings this week.
There you go. All right, guys, that's our show as always. By the way, I dropped a link to our scouting reports over the weekend. And those of you who are pro members, there's a lot of great picks out there, a lot of great setup stock pickers market like Coach Matt and Coach Gino were talking about earlier today. Go through those reports and update your weekly watch list. Review that newsletter to make sure you got full analysis in all the sectors and what's going on from that perspective. And if you are not yet a pro member, there is a link to the 15-day trial of our pro membership in every one of our YouTube videos right in the description below the video. And if you're out there still watching, appreciate you guys as always. Make sure you've subscribed. Make sure you've clicked that bell. Come back and join us on a daily basis. We go live every day. Markets are live at 12:30 Eastern time. All right, guys, we're out for today. We'll see you tomorrow.